John Taylor, welcome back to Living Markets with Liberty, our second episode for 2026. How are you, John?
I'm very good in yourself, Leon.
Yeah, very well, thank you. You know, the kids these days, they have this thing about 6-7.
Oh,
I was told
yes,
it's got
yes.
something to do with like it's somewhere in between the two. And I was thinking about those numbers, and I wanted to ask you, what does the numbers 3-2 mean to you?
I see. It's yeah. For me, 2 and 3 are the numbers after number one, Leon.
Oh, is it? Oh, no,
Yes,
but
yeah.
they're lucky for some and unlucky for others.
Indeed.
Well, John, I love interviewing you because you're one of the few people that doesn't ask me for the questions beforehand. So, related to your football team, I hope today I'm not going to make you choke.
Let's hope not.
And because I do have a couple of items I'd like to get into and get your views on. And also from the perspective, I want to dig into the surveys that have come out the end of this year, or for the end of last year, should I say, and look at it from the perspective of what do the numbers tell us?
Yeah.
What is our understanding of those numbers? So I'm going to share a couple of slides and we can talk through that and hopefully just shed a bit of light for the audience in that respect. But before we get there, just thinking a little bit about the markets. I mean, the markets continue to be the markets and are up one day, down the next day, but generally trending upwards. And I saw some stats that came out I think it was actually in Citywire this week, where they spoke about it's the most bullish South African asset managers have ever been in terms of equity. They all sort of maximum equity, minimum cash, if I could put it that way, which is astounding given the 40% last year. But it just shows you that there's still pockets of value that the guys are seeing. But everyone was hoping for a rate cut yesterday, and that didn't happen. So why not? And what's your views on future chance of rate cuts?
Yeah, Leonard, in terms of the rate cuts, I think I was also a little bit surprised in some ways. I think I was probably less surprised because of the fact that rates didn't get cut in the US by the Fed on Wednesday night. So that kind of informed that I thought, okay, maybe we take a more cautious approach. Inflation remains benign. It's still above the new 3% target, but not by much. 3.6, I think, was the latest reading, the December reading. So I think it tells us that there's a bit of a wait and see approach, as well as continue a bit of that hawkish tone. I was, I guess, more taken aback well, not taken aback, but intrigued to see how Jay Powell and his Reserve Bank governor colleagues, or governor colleagues, would react to obviously the ongoing tensions between the administration in the US and the Federal Reserve, and particularly given that Powell has very little time left to run out, but there do seem to be pockets out to get him anyway, before he steps down as Fed chair.
Yeah, he's definitely holding his stance, and bravely so. But maybe that's because he has Mindar, so
Yes.
can only be. So yeah, so the MPC put out a summary. So they're saying inflation's ticked up to 3.6. So the average was 3.2. So it's showing a little bit of an upward trajectory. So I think that's why they were a little bit more cautious
Yes.
in terms of it. And they're saying globally the geopolitical tensions remain elevated. Well, really, there's no
Understatement.
news in
Yeah.
that one. We're busy playing war games with China, Russia, and Iran. We definitely have chosen some fantastic friends at this point in the world's history. And also inflation outlooks. So they see inflation slowing in the near term, helped by the stronger rand, lower oil prices. However, services inflation is still about 4%.
Yep.
So there's both good and bad. So I think the expectation is that there will be more cuts later in the year, also leading up to the municipal elections. That'll be a popular thing to do.
Yep.
But the reality is it's not a slam dunk that it's all fully under control kind of thing. So I think they're just being cautious in that regard. And then we're seeing some economic growth, but the reality is it's 4 quarters of growth, but it's not sufficient growth to generate jobs or to get overly excited by. And that's because of the geopolitical side of it that's not coming to the fore.
Yep, 100% right. It's the GDP growth, at least it's kind of ticking up a little bit, kind of quarter on quarter. We're obviously keen to see the quarter four numbers, but they're way off. I think we only get them beginning of March. You touch on a bit of a bugbear of mine around the inflation numbers, particularly at the start of the year. And I don't know why we have this obsession with averaging an inflation number from the previous year. You're actually averaging, to get completely technical, it's like a second derivative. You're averaging an average. And for me, it's more important to look at where the actual December print ended at, the 3.6. It has ticked up. Perhaps it's a bit of a strange bugbear, but it's important that we keep our eye on how that first line is moving, as well as the speed at which it's moving.
But tongue in cheek, it's convenient for employers when giving salary increases if the average is lower.
Could be that, yeah.
So Natalie our editor, is taking it upon herself to remind the market of the predictions that we gave in our last episode, and so far she's giving you the winning accolades.
Early days, Natalie. Early
exactly.
days.
So that is exactly the point that I needed to make. So what Natalie doesn't realize, it's very early days, and I was actually quite disappointed because I shouldn't have been disappointed, but I was. But I interviewed an economist from France Crunier Private Clients, Becky and Schlobo, for our Power Plays and Paydays podcast, and they called the rand strengthening off the back of dollar weakness, and that was going back now 2 years or so, and they're calling for it to strengthen even further to around 15. So that wasn't music to my ears, because I have a bet now, so I'm expecting weakness to come through, but there are still many days to go till we get to that point. So when I'm going back now 30 years, when I first started working, and one of my first jobs was to put together a performance survey. And it was within an actuarial division at Alex Forbes, or Alexander Forbes as it was then. And literally the entire survey fitted on one page. It was just balanced funds. There was no international assets or anything like that. And we were so proud of ourselves because we managed to color code the different quartiles. And that was quite an achievement that we had managed to unlock. And those surveys were useful because they were a good summary, and clients could use them to sort of see what else was out there, where were they stacking up. And we used to do a lot of comparisons of how the particular fund was performing with the manager versus the manager sort of aggregate in a similar mandate and so on. So they were used quite extensively. Nowadays, I find, I need someone to decipher the surveys for me.
Yeah.
I just struggle. There's so much. I don't where to look and what the differences are. I actually don't know who uses it. I'm not certain the actual value of them these days. I think the surveys that are done are magnificent, but just the usability has become questionable because it's so complex. So I decided to take a look at the equity survey that Alex Forbes produces, and to sort of work my way through it. And I was struggling. So I thought, you know what? I've got a call and an interview with John. So we're going to put it into slides, and John's going to help me do that. So what I'm going to do is I'm going to share a couple of slides that I put together, and I want to work through some aspects within it, and let's see if we can explain what certain things mean, and what's good, what's bad, what to look out for, and so on. And I'm not really going to pick on any managers or manager results, but it's more the type of analysis that's been done, and what does that mean. And then maybe we'll look at one or two managers. We'll see. This is a slide that there was an ex-colleague / boss of mine, Cyril Ginsberg, who was the founder of Ginsberg Consulting back in the day. And he used to call this a slide that was nothing but fly excrement, but he'd never use excrement. He used a much worse word in that regard. So it's always been a very busy slide. It's a risk-return scatter plot. Yep. Now, this one is specifically measuring excess return, versus tracking error. And it's on benchmark cognizant funds over a period of 3 years to the end of December. So let's start there. First of all, what is a benchmark cognizant fund?
Yeah, important we unpack that. Benchmark cognizant funds, in short, I mean, this is for equity-based funds, so purely looking at funds that are investing chiefly into the equity market. And what this is saying is these are managers that are basing their positions relative to an index. Not all of them are probably the same index. In fact, they definitely not. But a lot of them would be, for example, now a CAPSWIX type index. And you can see that in even the name of some of the portfolios, if you just scan through here, where it picks up sometimes what particular index they are effectively positioning themselves relative to by taking over or underweights to certain benchmark positions. So they're not building it from the bottom up with a limited number of shares. They're actually starting off the base of what the index looks like and saying, we like company A and share A, we don't like company B and share B.
Okay, and so that's measuring the excess return over that particular index or benchmark. Now, tracking error, that is an indication of?
Tracking error then says, how the excess returns almost the outcome. It says at the end of the day, their set of choices of going over and underweight in collection either resulted in them outperforming or underperforming that index over this 3-year period that they're looking at here. The tracking error, on the other hand, almost measures the noise around how they did that. So they might have been able to outperform it over the 3-year period, but it could have been a lot of spikes upwards and downwards relative to the market, and that would result in a much higher tracking error. If they hugged the benchmark a lot closer, so in other words, they stuck quite closely and they were able to eke out a little bit of outperformance, but it wasn't in a very noisy way relative to that benchmark, then they'd be further to the left of this graph.
And the 3-year period, why 3 years? Is 3 years sufficient to take noise out of the system? Is it pretty standard to use a 3-year term?
3 years, I would always argue a longer period is better. In theory, at least 3 years, you shouldn't get like one trend that comes through, like a trend that dominates a 1-year kind of period. But 3 years for me is a little bit short to be trying to make calls around money that's going to be invested. And in equity funds, you'd assume it's going to be invested for periods quite a bit longer than 3 years.
So if I then look at this, there's a couple of things that I take away. So first of all, strictly speaking, you want to be as far up the vertical axis as you can be,
Yep.
and as far to the left on the horizontal axis. So high excess return, low tracking error. That's the ideal, but sometimes that ideal is not really realizable, if I could put it that way. So if you're sitting like 361 and Vunani over there, well, that's great from a return perspective, but you need to understand that there's been a lot of noise and ups and downs getting there,
Correct.
and that can turn around pretty quickly. Is that a reasonable sort of
That's a
assessment?
reasonable point. So if you are looking for a fund that's benchmark cognizant, that usually means you're an investor that's trying not to take on a lot of um, call it excess risk or tracking error risk. You want to hug a little bit closer, but you trust that there is something in the market that allows active managers to outperform. Yes, you would argue you'd want to move to the left. That doesn't mean that managers on the right of this graph are bad. It simply means that they might not be as benchmark cognizant as their peers, and that might be a stated aim of theirs. But nevertheless, it's important to understand that outperformance, so being higher on this graph but being on the right, is more quickly going to sway up and down, whereas on the left, it's a little bit more anchored to their position in theory.
Okay, then if you have a look at the likes of Momentum Investments, Classic Equity, Alex Forbes, Accelerator Equity, I'm trying to see if there are any others. So the multi-manager type solutions, by default, because it's multi-managed, you're taking some of the noise out because you've got a manager offsetting another one in some way, shape, or form. So you'd be expecting to see them trending towards the left of the tracking error. At the same time, over short periods, it's difficult for them to sit at the top of the excess return.
Yep, exactly. So by multi-managing, you are reducing your reliance on one manager's view, one manager's style necessarily. So you should expect that they should have lower tracking error because you're removing some of that specific risk or kind of idiosyncratic risk. what you're trying to then do is to also see, can that multi-manager pick a selection of managers that over time will be able to outperform the index, which is basically saying they should outperform the zero line in the graph.
Okay, cool. So then the other thing that this is more just a throwaway, Vunani has bought Sentio. Now, when you look at Sentio, performance not looking good, going into a firm like Vunani where performance is looking good. Now, there might be good reasons for that, but if you have a look, Sentio General Equities Cap Swix, Vunani Active Cap Swix. So they're similar in terms of nature. Maybe one has a greater tracking error allowance or something like that. But what it's showing us here is that that's an interesting dynamic when merging two firms.
Yeah. And I guess it comes down to an even broader thing when you're looking at surveys, particularly over time, is that kind of survivor bias that starts to kick in. And that's why shorter time horizons are sometimes more reasonable. You look at a 10-year graph, it doesn't allow for the fact that the same universe of managers weren't available for that whole 10 years. It ignores funds that have been closed and merged and gone under, and inevitably you'd understand that the ones that underperform are merged into ones that outperform, not the other way around generally. So it is just something to be aware of in these surveys.
I think it's actually a very good point. I'm going to come to it just now, talk about passive versus active. But in these surveys, you get a thing called survivorship bias.
Yeah.
The weak fail and disappear, the strong grow and remain. And the means and the medians, they get uplifted through that process. So sometimes the analysis is not always fully accurate, if I could put it that way, because of the failures.
Yep. I'll make some more comments later. I don't want to preempt anything.
Cool. All right. So then there was another fly type graph in the surveys. This time, risk versus return scatter plot, benchmark Cognizant 3 years, and now we have volatility versus return. So we all know what return is. So explain volatility.
So this one is a bit of a simpler one, I think, than the one before. Even still, volatility can be very confusing. A lot of people will just say it's kind of the amount of ups and downs or the variances effectively in the returns over time. So the easiest way to understand volatility is, did this get all achieved in a straight line, in which case the volatility is actually zero? Or were there lots of ups and downs along this line that generated the 19, 20, 24% returns that you see on the left-hand side? So the more squiggly that line is in terms of achieving this ultimate end number, the more volatile the number is. That's a nice way, but not the only way, and not always the most important way of measuring risk. So often when investment managers or asset consultants talk about risk, they actually are talking about volatility. It's not always the same thing. In fact, often it's not. But volatility is a nice way to condense just how noisy that ride was, or just how rough and bumpy that ride was in achieving the return.
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channel by clicking the subscribe button below, share this video with others you think will benefit from it, and give us a thumbs up if you are enjoying the content. That way you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za.
So I'll explain just how noisy that is for the average investor or trustee of a pension fund, because look at 361.
Yeah.
They're highest in terms of tracking error, so they can look quite different to their benchmark, which creates variability. Yet from a volatility perspective, a performance around their own mean, they're very low. There's a lot of consistency from that perspective. So they high risk in one place, low risk in the other. Which risk is important? I don't know. And that's a challenge that people ultimately will sit with. And I think it comes back again to that these are measures to try to understand the nature of what you're looking at. Ultimately, for a fund, the risk is the risk that investor ultimately feels, the liability that they have, the stomach that they have to ride the waves. And that's how they should look to measure their own risk rather than try to relate it to asset managers like this.
Yep, spot on. So, depending on your time horizon, the fact that a fund like Vunani or Sentio or Camissa on the right-hand side of this graph, they may have delivered returns in a very lumpy way, in a very volatile way. But if you have got a much longer time horizon than the 3 years looked at here, 5 years, 10 years, that might not matter so much. But if you are a shorter term investor, and this graph in general gives you a good sense of just how risky it can be in an equity fund. I think it's important to also just notice the scales here. When we look at the left-hand side, it feels as though, okay, that's low, but it's not low. 10 and a half is the starting volatility on the left. It goes as high as 13 and a half. So it's also important when you compare again from one survey time period to another. There are time periods where equities have much lower volatility than this. This is a particularly volatile period for equities, even though we've seen fantastic nominal returns. So the numbers on the vertical axis are really nice and high.
Just the one thing when we talk about term, I also find term being interesting because retirement funds or most investors are long-term in nature. But there's time to when you need the money or term to when you need the money versus the day-to-day psychology of having an eye on your investments. And those two are quite different, and your emotions can run you, awry in that regard. So when you look and think about term, it's quite easy to say, yeah, no, it's 10 years plus without a problem, but you've got to manage your own emotions through that process. You can't do that and then suddenly, panic after every downturn.
Spot on, Leon. The biggest bit of the psychology for me is as technology has evolved, it means that we have access to information around this sort of stuff more frequently. And that is affecting human behavior enormously. Where if you only found out let's ignore the old defined benefit funds. Let's just focus on defined contribution funds. If you saw your share of fund in a statement as a total rand value only once a year when you got a benefit statement, your reaction to changes in that number are very different to now checking on an app, on a portal somewhere that you can see it updated daily, sometimes even hourly, kind of pricing live to the last 15 minutes. That changes your behavior enormously around how you make decisions, because you have a day like today, markets have actually dropped quite a bit, 3-4%. But belies the fact that the month is actually up like 5-10%. If you've been in gold, you made big money again in January. So it's important to just keep that psychology in mind in looking at these graphs.
So the final thing then that I take from this is if you have a look at the gray little points in the middle of it all there, so that's the all share index, and then you've got the cap Swix and the Swix all share index as well. Now it's showing the all share index has outperformed. Why? Higher mining exposure, gold exposure than Swix. But to me, the biggest takeaway is those three blobs trend towards the upper end of all of the participants. The majority of people have actually underperformed the index, yet when you compare it relative to the mean, so the average, the outliers, the 361s, the Vunanis, they push that average up because they're at such a level. So a mean can also be quite what's the right word? Misleading. And that's why often what I tend to look at is where are the quartiles? So where's the start of the upper quartile versus where's the start of the fourth quartile kind of thing, and judge from that perspective, because you might say that returns have been looking so good on an average basis, outperforming the indices, but that's not truly the case when you look at it from a median perspective.
Yeah, you're right. If you just look at this and you ignore all the other dots, you just look where those gray dots are. They look like they're in the middle of the graph. So your mind immediately says, well, actually, it's half, up and down. It's critically important to look at quartiles. If you're not going to want to look at so many numbers, even a median is probably less misleading than the average or the mean in this case. And I think the other key thing to just keep in mind, most surveys, certainly in the institutional space, and this one is one of them, these are grosser fees. So what we're seeing here is that more than half of these equity managers have failed to deliver above these indices before you even deduct fees. So it is just something to always keep an eye on and say, if you are benchmark cognizant, and you're an actively managed fund that's trying to eke out a bit of outperformance above that benchmark, it's been extremely tough for these guys to do, certainly consistently over 3 years, and that time period is obviously actually a lot longer if you look at longer term graphs.
What is a reasonable adjustment? I mean, like, you can get index funds now at zero cost, but let's say a reasonable adjustment gross versus net would be 40 bips, 50 bips.
It really depends on the size of fund you're looking at. Obviously, the fee negotiations are largely scale based. But yeah, one could argue that if you, especially a single asset class like equity, you probably are able to adjust for it anywhere. I would say for smaller funds between 60 to even maybe 100 basis points or 1%, that would be probably a very high fee in this space. But for bigger funds, it starts to tend down towards the 40s.
Okay.
Yeah.
So let's also then look at that a bit more. So if I move on, so now this is, again, I've stuck with it's showing both benchmark cognizant and not benchmark cognizant, but I'm just going to stick with the benchmark cognizant for our chat. And now it's showing the quartile. So it's showing who's the highest, upper quartile, median, average or mean, and asset weighted average. So now trying to allow for size within it.
Yep.
Lower quartile, lowest. And then what is the range? So I always look at the range because I was brought up and told that investments or asset managers perform in a funnel. So in the short term, there's large variance. In the longer term, there's little variance between the managers. And having a look at this, I say, what a load of bull. Okay, because the return variance or range over 10 years on benchmark cognizant funds, majority of which are SWIX benchmarked type funds, 7.66% per annum.
Yep.
That's per annum. So if you get it horribly wrong, it's going to cost you an absolute fortune. I mean, that's probably 100% compound.
100%. Yep.
So the art of manager selection, I think as an asset consultant, you need to demand more pay because, I mean, the reality is it's an awfully important piece of advice that you're giving.
Yeah, it is. And I think it reflects a couple of the points that we raised a bit earlier. So I'm going to revisit the point I wanted to make because I think it fits in nicely here. Firstly, that funnel of doubt thing works well in theory, and it's important to keep in mind, particularly in the index space. It probably, relative to like a CPI, it starts to make more sense. And again, it's easier to say now that markets are running at 20-30%. It's harder to sell that point when equity returns are much lower. But the actual range in terms of manager performance remains relatively high. And I think it links a lot to how these things get measured. I know some surveys do it in a way that I prefer. This is one of them, where instead of looking at a 10-year return as simply those funds who've been around for 10 years, what's the median, what's the first quartile, what's the third quartile, etc., around that, which is very misleading for survivorship bias. It's not considering funds that have failed and exited the survey that generally would have pulled that average down, but rather link month to month and say, what are the returns on a month-by-month basis on median across all the funds for those 120 months, and pull that together. And then you do get these interesting kinds of ranges because it allows for the fact that some funds that you're not seeing in previous graphs are actually being accounted for because they were in the survey 5 years, 10 years ago.
Now, so you can see a similar picture if you go back 7 years. The range is 9.71%, 5 years, 8.5, 3 years, 8.8, all per annum. And then you can think, well, maybe that's benchmark cognizant. What about the not benchmark cognizant? The picture's even greater. in terms of that range. So again, it just points to the importance of thorough due diligence and analysis of your asset managers and holding them accountable as well, in terms of, because the impact on the back pocket for members can be quite significant. It also talks to, again, can you pick managers to outperform? Can you do that in a way that's reasonable? I'm not going to answer that question, but the reality is that's also part of the comparison when looking at index funds, because you've got to make sure that you can find the guys to trend towards the upper end.
Absolutely, Leon. Something that's really important is, and you call it by the right name, they're index funds. They're not passive funds. Because passive implies you plug, you play, you forget, you move on. And it can't be, because just as there are many different investment managers and strategies that they bring to the market, there are lots of different indices. I think the JSE alone publishes over 200, 300 indices. I know there's a lot of consolidation in them at the moment, but that's still not going to bring it down to one golden truth number. So you kind of are stuck that you need to understand the implications of the various indices that are available in the market, and what the implications of how the manager is managing to that index. And you need to think of this as a bit of a continuum. If you look at the benchmark cognizant funds on the previous list, some of them actually are what I would call smart beta type funds, or I mean, they called lots of interesting names these days, fundamental indexation, all sorts of things, or systematic investing. Effectively, it's trying to say, okay, there's an algorithmic overlay that describes how we are choosing what to overweight and underweight. Okay, remember, it all comes back to how close to the index are you holding these things. It's either not at all, which is not benchmark cognizant, or it's benchmark cognizant a little bit closer or very close. And the importance then is to say, you can't just look at the tracking errors and the excess returns alone. You need to say, is that a quality index that we're actually looking to replicate in some way? And that becomes the question mark around how do you make sure your index fund is appropriate for your strategy.
Okay, so let's move on and see what I've got coming up next for us. Right, so now what I've taken here is based on active returns. So the previous one was based on actual returns, and now this is taking a look at, call it, outperformance of the benchmark and what the stats are showing us in this regard. So you can see there, highest 4.5% outperformance of a benchmark over 10 years, that's per annum. So on that basis, well worth paying for that active management.
Agreed.
But the average 0.26. Okay, so the 0.26 is pre-fees. Remove fees from that. The question mark comes in again around, the value, and that's over a 10-year period, so it's a significant period. But maybe it was just lucky. Let's go back 5 years. That's 0.57. So again, it's always equalizing a bit between the two, which is interesting. And then the risk of targeting the 4.5 is that you end up with the minus 3.25 per annum. So again, it's an interesting discussion in terms of the value of manager selection and the ability to consistently select managers that will outperform.
Yeah, this is a nice proof case. I think this does illustrate that South African managers in particular have been a bit more successful if you can find that the medians and averages tend to be marginally positive over the longer times. Obviously, as you said, you need to allow for fees at some level, but it's still a better outcome than you'd find, for example, in the United States, where actually those the gross performances of the median funds are negative. So in other words, far less than half of those managers are delivering outperformance even on a gross basis. So something to keep a nice eye on. What's interesting for me when you look at this particular table is that the active returns across benchmark cognizant, not benchmark cognizant, enhanced index, they do tend to actually trend towards a similar number over the longer time horizons, which is something that perhaps surprises me a little bit.
And there was another point I was going to make So when I also look at the asset weighted average, I find that a strange one because it's sort of counterintuitive. As you perform well, the more you'll attract assets. So if you're doing an asset weighted, that's always going to look better than the pure average, simply because those guys have grown and therefore their better performance is going to take a higher weighting.
Based on if the analysis is done the way this one is done, where you're linking it, there's a little bit of that. Asset weighted also allows for the fact that, remember, the sum of the participants, if the survey truly covers the whole market, then the asset weighted average should actually equal the performance of the index, if you think about it. In reality, obviously, you can't cover the whole market. So it then implies that the survey as a whole is either outperforming the kind of money that's not reflected in the survey, or the other way around. It is pleasing to see that the survey tends to reflect over certainly longer time periods that the managers choosing to participate in the survey outperform everybody else participating in the market.
Yep. Okay, so now moving on. This is the final art test. Median average asset weighted average number of percent. What was the point of? So what I've done here is I've actually brought in the actual performance of the all share, the cap SWIX. So just so we can get a feel for that. So you can see the median and average on the benchmark Cognizant 11.3 to 11.04, the weighted 11.5, where all share was 12.4, 12.4 on caps all share, and then 10.58 on the SWIX all share, and 10.42. So you can definitely see there's a bias towards being more cognizant of the cap SWIX index than the all share, and the all share did well because of the resource overweight.
Yeah, that's spot on. So what you're picking up here is over these 10 years and for probably now the majority of that 10-year period, a lot of the managers, particularly in the benchmark cognizant space, have preferred the capped SWIX in particular because of concerns around concentration risk. It wasn't always in the miners. The miners have only become a factor, I guess, in the last year or two, but particularly for NASPers and Prosus. That was the main worry if you think back, 7 years ago now even. So it does imply that those concentrated positions in the likes of the NASPers, in the likes of the miners more recently, have resulted in outperformance. That's why your all share numbers have outperformed over those longer periods. You'll notice, obviously, if you come closer to the 1 year and even the 3 year numbers are starting to converge, where there is no difference between SWIX and non-SWIX indices here. So that effect is going to wear off over the next 5-10 years.
Okay. So look, we would be absolutely continue to be boring without a little bit of box office. Okay. So we can't just ignore the names over this period. So if we go have a look now, there's so much data of all the different participants, but if you look over the longer period in terms of who from an absolute perspective has performed well, you can see there 16.71 is Fairtree, 17.42
is 91 value.
91 value. They have their moments.
Yep.
17.29 is
the Sim
aggressive fund.
Yeah.
So just some of the names that are popping out, and that's over a long term. You've got here over the shorter term, 3 years, Coronation doing pretty well. Ned Group Investments, that's Laurium that manages that, 2691 again, that's done well. So typical names coming through. And what one that interested me, which maybe I don't know how well you know them, but Resco seems to have struggled. And that's a name that I heard a lot about. But their 1 year performance relative to benchmark it stands out significantly, 8.7 versus 42.4. Do you have any idea what's happened there?
Yeah, I think that's truly living up to your name of being not benchmark cognizant. They've taken some extreme bets over the past year. I think they've completely missed on the resources is one of the big drivers there. The end result is obviously severe underperformance over the shorter term. But if you move out to a longer time period, the 7 years, I think, is the longest they have there. That's the 14%. Yeah, it's hurt, but it actually hasn't hurt enormously. So it's one of those ones where some of these managers have extreme bets. I mean, on the other side of the spectrum, 91 value, that looks absolutely amazing now. Amazing manager there. And you're going to have to be willing to suffer years like you've seen with Resco. And I don't think that John Bickard is ever going to say that that isn't going to happen if you invest into 91 value. But just be aware that when it says not benchmark cognizant, it might be very not benchmark cognizant.
No, exactly right. And then I think the final slide that I brought in, these are on the benchmark cognizant, and this is based on the active returns. So if you look at the ratings, you can see 361 just trending right to the top, a manager that comes from a hedge fund background, real stock pickers, and they really have been consistently producing good stuff. Who else should we pick on over here? Let's try to find someone that's done less well. See the likes of Omig over the long term struggling a bit. You've got the Sentio numbers over the longer term, not great, which we highlighted earlier. Ashburton over a 7-year period, not looking good. In fact, consistently not looking good. And they're one of the bigger fund managers now in South Africa as well.
Yes, yeah. So yeah, it does talk to the fact, and if you just look at the spread of those numbers, and we referenced it a bit earlier, but even over the periods, the longer term periods, the active return, so the return when you take the index or the benchmark into account, can be quite stark. I mean, just looking at those 10-year numbers, anything from the 4.5 overs, for example, that I can see for 361. All the way down to the -3s for like a First Avenue. It does tell you that even over longer time periods, some strategies have performed really well and some haven't. And it isn't always mean reverting. As you pointed out, Leon, that range doesn't, at a portfolio basis, narrow enormously, certainly not over 10 years.
So as an advisor, as an asset consultant, investment consultant, financial advisor, when do you pull the plug? So you've got all of these numbers, right? You've got all of this analysis. You're seeing these trends. At what point in time do you actually say, hang on, these guys are on call basically, and at some point in time you pull the plug on them? What drives that in your psyche, in your advice?
Leon, it's the boring advice. I always get labeled for it, but the reality is underperformance isn't a problem if it's what you expected under those market conditions. No one solution is going to be a silver bullet and work in every market. If the prevailing market that has occurred and your manager has been up against, they've performed out of line with what you'd expect, that's when you need to change managers. That means there's something wrong with the philosophy, the process, the people, and that's leading into the performance. So don't punish a manager who you would expect to not have done well in that time period, and they didn't do well in that time period, but rather go after somebody who hasn't performed. You thought that they were going to deliver good returns under a strong gold rally and a weak dollar and all the current conditions. If they are not delivering the goods and you expected they were, you need to go kick the tires and fundamentally change things if there is something remiss.
So there's 3 things I take away from today's discussion. Firstly, you, as a novice, you can't accurately assess the analytics that's out there without some help, because it is too complex. There's too many different measures, different benchmarks, different ways of showing it, different combinations of different things. So without explanation, without some guidance, simply looking at the surveys, you could be comparing yourself versus something that's absolutely irrelevant and getting the wrong impression from that. So the surveys can be your friend, but they can also very much be your enemy. So you do need to seek advice around the surveys to appreciate that. When you seek advice, that professional has to come to you and be able to not just explain the numbers, but the context. And that comes down to the level of due diligence, care that advisor takes in researching what is ultimately out there so that they can identify why there might be certain numbers showing one thing versus another. That becomes critical. It is possible to find the better managers, and it's probably not that difficult if you do your research properly. But if you don't feel as though you've got that, if you don't feel as though you've got that support, well, then there's nothing wrong with indexing your solution. There is a definite cost benefit there. It's not 100% clear that active will always produce better results, albeit that South Africa has tended to in that direction. But there's no shame in indexing part or all of your investments.
Yep. No, I mean, lots I could say on it. I'm not going to. We can discuss it at a later point. Some asset classes it makes more sense to index than others. So keep in mind that the more liquid, the more traded, the more efficient the market is, the better or the more likely the index trackers are going to do relatively well compared to active. And that ebbs and flows as well. I think we need to also point that a little bit out. And then to your point, when you get overwhelmed by the range of information out there, or just the sheer behavior of these managers over different time periods, nothing wrong with building something that incorporates a little bit of both, so that you can take advantage of a bit of active risk, and you try to find some managers that deliver it, but you're not betting the house on any one color or any one name, and you can kind of take smart calls around your fundamental base that's hopefully fairly low heartbeat.
100%. You never ever know when you might end up with an Arsenal. That is just the best advice we could possibly give. John, thanks for letting me pick your brain. I appreciate it. It's very valuable for everyone to sort of hear the discussion and understand some of the points and explanations and so on. Just for the sake of the audience, next episode, John and I will be spicing it up a little bit and bringing a third party into the discussion who's going to talk to us about the markets, the economic outlook, and show us some analysis in that regard, so that John and I can start judging who will be right at the end of the year. So let's see what they have to say. So John, thank you so much for today, and I look forward to seeing you in the next episode.
Thanks so much, Leon. All the best to everyone.
Best. Cheers and ciao.
At Liberty Corporate Benefits, we believe that better benefits are better for business. That's why our holistic employee benefits give your employees financial security and lifestyle stability, freeing them up to be their best selves at work. With satisfied, engaged employees, productivity shoots up, workplace errors and loss decrease, absenteeism and presenteeism are reduced, and you attract and retain the best and brightest talent. After all, if you take care of your people, they'll take care of your business. Our brilliant basics are the non-negotiables that explain why more companies choose us than any other for employee benefits. Our employee benefits are easy and flexible, personal and relevant, and resource-backed, with investment solutions designed to help your employees retire comfortably. Comprehensive cover that protects your employees and their families. Financial literacy initiatives to help your employees make the most of their money. And a range of value-added services for holistic care and support. We make it easy to take care of your people and prove that employee benefits can also be employer benefits. Speak to us about getting the benefit advantage. Liberty Corporate Benefits.